Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to give you simple, easy to understand strategies, insights and tips to help you master the game of building wealth. And welcome to the summer series where I will share and review the three most popular episodes during 2022. Last week, the most popular episode was about economics. This week, the second most popular episode was about consistency. And in fact, I titled the episode "Consistency is the Key to Building Wealth." And in this episode, I'd sort of talked about eliminating unconscious expenditure to free up as much investable cash flow as possible, making regular investments, measuring your progress, and really taking responsibility ultimately for your financial position and the decisions that you make. And in 2023, I'm going to write a blog about you can't produce wealth if you don't make a regular contribution to your asset base. You can, but it's more risky or higher risk. So really, you can't materialize wealth unless you actually make a regular contribution. Anyway, that's for next year. But this podcast kind of leads into that. When reflecting, why was this the most popular podcast, second most popular podcast in 2022? I guess it really resonates with people that they understand that consistency, not intensity, is the key element here, particularly when building wealth. You can have one intense year of, going and buying a whole heap of investments, and then 19 years following that of nothing, and we all know that's not going to be enough. So I think it really resonates. Anyway, I hope you enjoy this episode, if it's listening for the first time or even if it's a nice reminder during the holiday period. Okay, on to the episode now. In regards to what I wanted to talk about today, I wanted to talk about patience and discipline. Two very important traits, I think, for successful investors. And I kind of find it ironic that, the two common mistakes that I think investors make is that they don't invest. Firstly, that's number one. Mistake number one is procrastination. And mistake number two is they tinker too much. They don't really stick to one strategy. They chop and change. So they're kind of at either ends of the spectrum. And that's what I kind of find ironic, that fewer investors really find the perfect balance. And of course, doing nothing is bad. Nothing comes from nothing. And I recorded a podcast back in March about that. But also, sometimes reacting, changing, tinkering, selling, buying, and mucking around with your strategy can be equally bad and can destroy a lot of wealth. There was a quote by Charlie Munger, who is Warren Buffett's business partner, has been his business partner since 1975. And I think it perfectly reflects, the power of patience and discipline. So let me share that quote with you. He says, "Look at those hedge funds. You think they can wait? They don't know how to wait. I've sat for years at a time with $10 to $12 million in treasuries, just waiting. As Jess Livermore said, the big money is not in the buying and selling, but the waiting," end quote. And I think what Charlie's saying there is that hedge funds are particularly very short-term focused. So, I think his criticism is very fair. But essentially he's saying that, the whole thing is about patience. And actually, if we reflect back on Buffett and Berkshire Hathaway, they've been sitting on a lot of cash over the past number of years. And if you went back, I think about 3 years ago and looked at their most recent performance, it was pretty ordinary. And that was because, all these technology companies that weren't making any money were very popular at the time and were worth billions and billions of dollars. But Berkshire Hathaway weren't participating in that. So compared to the market, they weren't performing very well. And the only major investment that they made, to my knowledge, over that time was they invested a lot more money in Apple. Well, in more recent time, given the correction that's happened in technology, Berkshire Hathaway now is performing really well. and it shows that, yet again, sticking to the fundamentals, sitting on a whole bunch of cash. They've got more than $100 billion of cash, and being diligent about what you're investing in really pays dividends. So, I think it's a good quote. He mentions he sat on $10 to $12 million in treasuries, which are bonds. Obviously, the quote's pretty old because at the moment they're sitting on $100 billion, but the point's well made. That is that quite often when it comes to investing, doing nothing is the most intelligent thing to do, although it's not always easy to do. So there's been a bit of research on this. In fact, there's a very commonly cited study by global fund manager Fidelity, and it said that they conducted research into which accounts performed the best. And they concluded that the accounts where the investor had forgotten they had the account, so that there was no engagement whatsoever, no logging in or trading or so forth, produce the best returns. So really invest your money, completely forget about it, and that performs better. I must say that I wasn't able to verify that study, so whether it's a bit of a tale or not, I'm not really sure. There was another study that, and this is just purely on stock market returns, and that covered about 66,500 investors, and they demonstrated that portfolio turnover, so buying and selling, was inversely related to returns, and that higher turnover leads to lower returns. On average, 5.5% per annum lower returns. And whilst this study only relates to the share market, the same theme is true, is that you need patience and discipline and stick with the investment for long term. And there's three reasons for that I'd like to talk about. And the first one is, of course, we all know that markets move in cycles. And I think that's true with all asset classes. The only difference here, I think, is that, and I'm going to do a podcast episode on it, is that I believe that residential property in Australia, it doesn't move, still moves in cycles, but the cycles tend to be a flat cycle versus a growth cycle, where other asset classes can have boom and busts sort of cycles. So, you won't get a lot of negative returns in residential property. And the reason for that, I think, is that it's a necessity rather than, a discretionary investment. But anyway, that's another topic for another time. So we know that markets move in cycles, and we know that mean reversion means that a period of above average returns typically follows a period of below average returns. And I've demonstrated that. I've got the link in the show notes when I looked at historic returns and cycles in the Australian property market since 1980. So that link's in the show notes. But if you're unlucky to invest at the beginning of a very flat period of growth, then it's likely that you've got to hold that investment for a much longer period of time in order to generate the long-term average return. So, for example, if you normally need to hold an investment property for, say, 10 years to enjoy an average return of, say, 7 to 8% in terms of capital growth plus then rental income. However, if you invest at the beginning of a flat period, then you really need to hold that property for 15 to 20 years. Now, your average return over that 15, 20-year period should still be the same, 7 to 8%. But the difference being that the distribution of that return is different. So it hasn't, you've had no return in the first 10 years and all of that return in the second 10 years. And investment-grade apartments in Melbourne are a good example of this, I think, because the last 10 years returns have been very poor, but all the fundamentals, sound fundamentals, in fact, and even when you see whole blocks of apartments sell, the intrinsic value is most definitely higher today. The market just isn't reconciled with that yet. The second reason is that returns compound, and so having the patience and discipline to stick with your investment really pays off in the long run. So again, I've got a link to another chart in the show notes that demonstrates this and looks at an investment property's compounding capital growth over a 30-year period. In the first decade, the property value increases by $580,000, so $500,000. In the third decade, the property value increases by $2.7 million. So what is that? 5 times the dollar value growth than in the first 10-year period. It means you really need to hold on to property and any asset that benefits from compounding capital growth, by the way, for 20 to 30 years to really enjoy substantial, ridiculous returns, really. In fact, mind-boggling returns. They're hard to sort of get your head around. And thirdly, you want to minimize transactional costs. Chopping and changing your strategy, buying and selling investments, it destroys wealth because of transactional cost and taxes, of course. So that's not to say that you should never make a change to an investment. Of course, if you've got a dud asset or a dud investment, then of course you should fix that as soon as possible, almost irrespective of cost, because typically the transactional cost is less than the opportunity cost. But making changes simply just because you're impatient, because the market hasn't delivered the returns in the time frame that you expected, that's not a good thing to do, and that's really going to destroy wealth. In the long run, fundamentals will drive returns. You just need the patience and discipline to sit with it. So just as a summary, the 3 reasons why you must have patience and discipline: markets move in cycles. Number 2, you want to benefit from compounding capital growth. And number 3, you want to reduce taxes and transactional costs. Now, of course, it's easier said than done in a lot of situations. And the reason is that most of us, as human beings, we are to some extent driven by fear and uncertainty. In fact, humans are hardwired to predict and avoid risky situations. And so we're susceptible to being influenced by negative news. And of course, the media takes advantage of that, and that's why all the news is always negative in the media. But we've got to remind ourselves that fundamentals never change, or at least very, very rarely change. Negative events come and go, but fundamentals are everlasting. And the pandemic is an excellent example of this, because it was a global phenomenon. It's as big as a negative event can really get, but it too will pass, and investment markets will get back to normal, and we've already sort of started to see that. So therefore, if your original investment decision was based on sound fundamentals, using evidence-based, rules-based approach, then you must not change that investment unless there's overwhelming evidence that long-term fundamentals have changed. And I would caution that long-term fundamentals almost never change. But having that faith in the face of a lot of uncertainty and a lot of volatility can be challenging. I remember, and I can't believe I'm going to quote this in my podcast, but I did watch The Crown, which is a series on Netflix. And I remember there was a quote that the Queen said, and I quote, "To do nothing is often the best course of action, but I know from personal experience how frustrating that can be," end quote. Now, I don't know if she actually said it. It's a historical drama series, so maybe she didn't say it. But I remember listening to it, and it really resonated with me because it eloquently describes exactly what it's like for successful investors. You feel tempted to make changes when you shouldn't, or delay investing simply because you're unsure. It's like logic and emotion are having kind of a tug of war in your own head. And I find it too myself with, looking after myself, my own and my clients' investments in times of very high uncertainty, or when markets are reacting or behaving like they shouldn't be. It is very, very tempting to really consider whether you should make any changes or you should hang in there. And in most circumstances, doing nothing and hanging in there really is the right way to go. And perhaps we can turn it on our head a little bit. If we are feeling that level of uncertainty, maybe that's really a good buying signal. Because in times of uncertainty, typically that's a really good time to invest because, prices are a little bit volatile and maybe you can buy an asset class for less than its intrinsic value. And we've certainly seen that, over the last sort of 15 years or 20 years since I've been in business. The two particular periods that really jump out at the GFC and COVID. I recall my wife and I bought a couple of properties in 2008 during the midst of the GFC. They're two of some of the best transactions we've ever made in property. Similarly, we invested a lot in the share market in 2020 when COVID hit, and that's performed very well as well. So sometimes that should be a buying or investing opportunity. And similarly, when conventional wisdom is there are no risks and everything's going well, and markets are going gangbusters, perhaps that's a good signal to sell. If you've got an asset, an impaired asset that you need to sell, sometimes that's the best time to sell when everyone else is buying. Okay, to sum up then, if you've invested in a high quality, fundamentally sound asset, the best thing to do is drown out any negative noise and absolutely do nothing. In fact, forget about the investment, forget about they exist. In the long run, the investors with the most patience receive all the financial rewards. Okay, that's it for me for this week. My next podcast episode will be released in 2 weeks' time on the 18th of May. Until then, take care.